Hi, and welcome to today's Q&A. It's Friday, sorry, it is Monday, the 18th of November. So we're kicking off the week. And what I'm going to do is I'm going to see if I can share my screen as I've prepared just a little something to go through with you guys today. Hi, Aaron. I hope you're having a good day.
Hi, Helena. Yeah, I'm doing very good. Hope you are too.
Let me know when you can see my screen. Can you see it okay?
Yes, I can see.
Okay, perfect. Okay, so I'm going to let me know if you also lose it when I navigate away. Have you still got my screen?
Yeah, maybe when you're going through the seconds, you might have to zoom in a bit, but other than that, it's good.
Okay, so hopefully we're on our way. And what I really wanted to talk about today, before we jump into some of the questions, is a thought that would have been helpful for me when I originally started. So when I started my business and I went through my different funding rounds, it was very much about learning as I went and fighting fires and rising to the challenge. And I wish that somebody had said to me, actually, there's a really a healthier way to set your future success up if you're mindful of it now. And really that is about engaging with investors early. So there's kind of 5 key points which lead to the 6th point, but I wanted to kind of go into that today. So the reason really to start engaging with investors from the beginning is because you can essentially build the trust with the investor from the very beginning. And investors like to have, they like to know you, they like to have had that history, something that they can look back on. They like to feel that there is a relationship. And also at the same time, having an investor on, or whether they eventually become a board member, it is like having a marriage, and it isn't something that you want to go into lightly. So this gives both the founder and also the investor an opportunity to get to know you, for you to get to know the investor. Now, another key element is when you get to know these investors, you can unearth all of their experience and you can ask them lots of questions, you can grow, and it has so many added benefits over time. So another point is when you're looking for an investor, it's really about being specific. So it's not about you know, kissing 1,000 frogs. It's about finding the investors within your space that have a similar history as the product or service that you're going to build, so that you can be so specific with your experience or the questions that you've got. And the more experience that that investor has, the more helpful they're going to be for you. Obviously, every business is very different, but if you can leapfrog ahead of people because you've got additional support, additional experience, that is an amazing added benefit to running and building your business. So it's important to find investors that actually align with your vision, even if it's not the same type of business. And then what's really good about engaging with investors from the very beginning is that you can share all of your success with them as you go forward. So there is an incredible amount of success in the beginning, and it doesn't feel essentially you're starting from zero. So starting from zero, every single thing that you do is successful. Whether you're having to adapt, whether you're having to tweak, you can learn a lot in that process, and then you can share that with the investor. So being able to start very early, it builds confidence. They get to see that you're the type of person that says they're going to do something, and then you implement it, and then you achieve what you say. So if you've got that evidence and they've got that awareness that you're the type of person that delivers, when you think about saying to them, actually, can I have some money to do XYZ, they've then seen all of this historic evidence that you're the type of person that does what they say they're going to do. So keeping them up to date on your milestones, on your progress before fundraising is a very good way of increasing the confidence in you and in your business. Another key element, well, I kind of touched on a little bit earlier actually, was seeking feedback and then acting on it. So one of the things that you're going to find is a hurdle as a founder is that you do need to seek advice from people who actually know what they're talking about. Lots of people can give you advice, but if they haven't been there and done that, do you know that you can trust that data? And even if it's another investor, but it's not in your sector, they don't have the relevant experience, they can absolutely give you the wrong advice. I've learned that the hard way, and also from my own perspective, it was very much about learning to trust my gut. And if you have somebody that's been there in your sector, knows exactly what you're talking about, that can help build your own confidence with your own gut, but also you're less likely to be taken down a route that you shouldn't really be going down. And again, in this piece, it is about building that trust with the investor. They see, they give their input, and that you can think about it. You could also push back and say, no, I don't really, I understand what you're saying, but that's not what I'm going to do. That again is a positive. You can then take their advice. That then is also a positive. So it is a really good way of building that relationship with an investor. And then the shift, which is pretty key. When you're asking somebody for advice, or if you're trying to build a relationship that's very, very different to taking a cold relationship that you've just outreached to and then asking them for money. So it shifts your pitching to building lasting relationships, which you can then more easily change and ask them to fund your business, and they'll have a lot more trust in you, a lot more trust in the business, or they will be saying, having seen all of that and having understood your business, that you're not the type of business that they actually want to invest in. So I think what's really key is getting to the point where you know the investors in your space. Ideally, you can look at founders that have already built something that's similar but is not a competitor. So it could be in the space but a different service, doesn't actually do what you do. Or you could go outside of your space and look for the key components within your business that is in a different industry. So it isn't about finding one person, it's about finding quite a few, and it's about nurturing those relationships over time. Now, it is something that I was when I was doing this, I was thinking about having an advisory board and filling the advisory board with all the potential investors that you might want to have invest in you over time. And that is a great way. The amount of people that will be more open to engaging and having conversations with you because you're seeking advice, or because you're saying you respect their experience and what they've been through, and then that slowly and gently can turn into a funding situation. But in order for that to happen, you have to be seeking this early. It can't be you're going to start fundraising in a month's time and you're setting up an advisory board for investment. So it is about thinking about this from the beginning and using this as something to develop and grow your business at the same time. So for example, they can help you to develop your pitch. They can help you develop your business plan, where you say, these are the milestones we're going to be going after. What do you think? And they can then feed back on that and say, actually, I think you need to be looking for this metric. You need to be proving this point, or this is the hurdle that you're going to come up with. So those are all the kind of the key reasons I would be saying it's really important to think about having a relationship and building that relationship with investors from an early perspective. And then what that means essentially is you have to start building your list well in advance before you need it. So going through all of the different processes of looking at who are the angels in your sectors, who are the angels that are interested in pre-seed or early early startup businesses, because they're very different from angels or VCs that are interested at a later stage. And going to networking events, going to founder pitch practice events, communicating, reaching out on LinkedIn, sending emails, asking to get in front of these people, so that you can ask for their advice. So that's really what I would say is a female founder that isn't currently looking for investment, you should still be considering starting.
And Helena, I just had one question I was writing down actually as you were speaking. You talked about building a relationship with trust and communication with the investors, and sharing your early wins is a good way. Does that also include some of maybe the, not losses, but some of the milestones you just missed or deadlines? Is it important to be honest with the investor, or is this like a dating phase where you want to put your best foot forward?
Yeah, I think this is a great example of when it is about being honest. It slightly differs in, you've always got to be honest, but it slightly differs in how you present it when you're actually in the process of fundraising. But in this stage, when you're nurturing and you're building that relationship, 100% is about being honest, and it's about asking for advice. So if you are struggling with something or you're missing your milestones, that is the perfect opportunity to say to somebody that's been there, done that, or knows what it's like in your shoes, to say, what do you think? How can I get around this? What else could I do? Can we brainstorm? Can I get your opinion on my next plan, or how I believe I'm going to solve this problem? What do you think? So yeah, 100%. Great question. And so I think as it's just you and I today, I believe you've got some questions from the community already. Do you want to just go through and ask some of those?
Yeah, I have questions here for you to test you. So the first one I have here: how can I validate my business idea before seeking investment?
Okay. So I'm presuming that this means that it's right at the validation or ideation stage. And in that stage, that's where you need to start thinking about who is your target customer. And if it's a customer or a client, or you've got suppliers or whoever is in your audience as a brand, you want to start speaking to those people. And that's kind of, say if it was if it were speaking to customers, you would want to go and actually meet your ideal target audience and have a conversation with them. So you could do that verbally. You can do that through testing it out in a sort of almost an MVP stage, where you could create an ad, you could be selling it, you could go into forums, you could say, I've got this, or has anybody got this problem, and would this be interesting? You can create a questionnaire and put an advert to the questionnaire to get some feedback. You could offer an incentive like a £50 Amazon voucher if people from your target demographic answer that. You could go through, you could target them specifically in sort of Facebook or Instagram. It depends on who your audience is, and it depends on whether that is consumers or whether it's businesses. But essentially, you'll want to try and find evidence that your idea is a solution to a problem, and you kind of need to validate both the problem and the solution.
Nice. My next question I had was, how do I conduct effective market research? So it seems like you covered it, but maybe you have something else to add.
Yes. So market research. There's a lot that you could do. So in this stage, this is the exciting ideation kind of phase, which I really like being in, and there's a ton of information that you can do. So first of all, I would look at understanding the problem, the size of the problem. And when you look at the size of the problem, you look at what are the current solutions. And then you look at the solutions, and do they offer the perfect solution to the problem. Is your solution something that fits within that group, or is it completely new without a sort of a direct comparison? And so there's lots of different paths you can go to do your research within the market, but it would be competitor analysis, looking at what already exists, trying to find some data and evidence around the problem, looking at Statista. That's a website that's pretty good, so you can kind of go into different categories and see, you know, how many people XYZ. Going in, and there's lots of different things on like Google Trends. There are some market research free software that you can have a little play around. It's more around trends and insights, but once you've found something, then you can hone in a bit more specifically to ask the deeper questions, to have to try and target in particular who you're talking to, and if at all possible, speak to your friends, speak to your network, speak to whoever it is that you can that will support you in understanding this phase. And a lot of people will help, or rather they will say they'll help, and then you have to push them. So I guess one of the things that I have found really interesting is I'm somebody that always takes action, and so if anybody asks me for help, I take action and I do it immediately, even if it's to help somebody. So I've actually helped a lot of different founders with their market research, and I've shared things and whatnot. But when I've gone to do that, it depends on the person. So it could you could ask somebody a question, they say, yes, I'm happy to share that questionnaire with my friends or this demographic. And unfortunately, you have to be willing to chase, because most people don't. And so I've always chased a little bit, didn't want to burn any bridges with friends, and then have put some money behind it from an advertising perspective to get it in front of the right person.
Yeah, it's hard chasing friends. Okay, the next question I have here: should I consider bringing on a co-founder?
Okay. So my opinion on this shifted quite a bit. I wish that I had educated myself on this before I started. So in all the things I've done, I haven't had a co-founder, and that actually translates into an incredible amount of stress, weight, and all of the unseen things. So for example, if you have a co-founder, you can stimulate each other, you can bounce off each other, you can be more creative when you've got another person. And if you get on well with that co-founder, which you should do if you're going to go into that relationship, because again, it's like a marriage, you will find that that co-founder can lift you up and can inspire you when you're having your low moments. And yes, so I would say wherever possible, choose a co-founder. Now that's backed actually with data, because you probably have heard of Y Combinator, but they won't invest or bring anybody into their programs unless they've got a co-founder or a team. And that's because the vast majority of businesses that are founded just by one person fails. And that's through so many different reasons. The vast majority of businesses anyway fail, right? So then when you take and you just look at the percentage of businesses that have just got one founder, the vast majority of those fail. So to increase the likelihood of your business succeeding for a whole host of different reasons, yes, I would say choose a co-founder, but then to add on to that, choose a co-founder that is different from you. So what you don't want to do, and I have seen this in a few different businesses, is that the co-founders share the same knowledge and experience. So for example, if somebody is strong in marketing, you wouldn't want to bring on another co-founder that is strong in marketing. You want them to, if someone's non-technical, you don't want to bring on another non-technical. If someone is technical, you don't want to bring another technical. So you want to have complementary and separate skills so that your roles are really clearly defined. And that's also very true if you have more than one co-founder.
And I'm adding my own questions here now, Helena. I hope you don't mind. But maybe if you could share, what was your mindset on why you wanted to be the solo founder? You know, so people maybe be able to understand and relate.
Yes, I think it's because I did not spend the time up front to network and find the co-founder. So I would have loved to have another person like me. So when I'm saying the thing, not my skills, but hungry, really hungry for growth, somebody that works really hard, somebody that is has got a strong vision and will work towards it. If I had spent the time to find that person and they had an interest in the sector that I was working in and the idea, that would have been amazing. So the first thing is that I didn't do it, and I didn't do it early enough. And when I did come round to thinking, oh, I need to get a co-founder, and that was actually just in the pitching stage, I was realizing that investors have a natural preference for somebody having a co-founder. And then you add to that, from a female founder perspective, there is a big hurdle that I wanted to not see. I didn't want to believe that there was a gender bias. So it was early on in the process when I was feeling very much like I should have had a co-founder. And then in hindsight, I should have had a male co-founder. As horrible as that sounds, to have to kind of admit in today's kind of society.
Okay, great. The next question I have for you here then is, how do I create a minimal viable product, MVP?
Okay, so this I really love, and I guess it really depends on, I guess, who's asking the question, and whether their product is software or whether it is a physical product. But I'm going to try and take the core components, and there's a great book which maybe I'll find afterwards and share it, because one of the biggest struggles with creating an MVP is really creating an MVP, so minimal viable product. So you have to strip out everything that you think is needed, which is not needed. And so whenever you come up with a solution, try and bring it down to just the 3 kind of core components, or even 1 core component, and then drill down within that 1 core component to see what are the pieces underneath. So it really is about looking at the problem, the solution, and what would be the simplest mechanism to solve that problem, and trying to think outside of the box. Because at this stage, when you're creating an MVP, the only thing is to prove your problem and solution, and prove that there is a product solution fit. It's not about creating your vision. It's not about solving all of the problem. It is about saying, is there a problem? Is there a solution? And can we test that we can fix it? And if that's yes, then that's a huge green light. And then you can see, is there interest in it? And what you don't want to do is you don't want to spend an enormous amount of money or time on something that you can't really understand why it's working, why it isn't working. And so the simpler you can make it, the less moving parts, the simplest possible version ever. And it could just be a landing page with, are you interested in XYZ, as a concept validation, an MVP concept validation. It could be a prototype that you build on Figma, which takes somebody through a design interface like an app, and you literally have just built it out so that you click XYZ and they look through and they go from slide to slide to slide to slide, so they get an experience like a demo. Or it could be you map out a solution to a problem and you have just one element that you fix. So an MVP really is the smallest possible solution to a problem so that you can take that to the next stage.
Yeah, it's funny. It's so obvious when you say it, and then when you try and do it, it's so quickly you get involved in the little features and the nitty gritty, and you just have to pull back and remember what you're trying to do here.
Oh, and then in addition to MVPs, nowadays the technology that's available is amazing. So probably, I don't know, 5 years ago, if you were to look to create a website, you'd be thinking the most basic website would be, I don't know, £5,000. Or if you're thinking of starting a business, it might be, you know, someone's going to think, oh, we're £60,000 to create a website or a solution or a software, a tool, a prototype. Nowadays, you can fix it with a solution. For example, there's a solution called Bubble, and you don't have to be a developer. It's effectively no code, and you can build it yourself, or you could pay someone to build it. And what would have taken somebody 6 months, 3 months before can be done in weeks. And so obviously the cost of that is tiny in comparison to what it used to be. So it's really worth trying to map out what is it that you need to build, and then remove your experience around what you would have built it with, and look at today's technology, look at the opportunities available today, and see what is the cheapest way of fulfilling that.
Great. So, speaking of saving money, how do I create an effective marketing strategy on a limited budget?
Oh, that's like the age-old question that I've been asked for like years, when I was running a digital marketing business. And it really, unfortunately, it kind of relates to who your target audience is and where are they. And you want to be speaking to your target audience, and you want to be creating content for your target audience, or you want to be putting yourself in front of them, however that looks. I always like to think of having as a business, if somebody checks you out, how are they going to naturally check you as your business out? They're going to look at your website, they're going to look at your social media channels. And in theory, whether your audience is in that channel or not, that's where someone might go to find out more about you. If you were a restaurant, they'd probably look at reviews. So again, it depends. But if you're a service or a product, they would look at your website, and then they might check you out on the social channels. So the first step for me has always been build a basis of content that explains who you are and what you do. And that is just as a foundation. That's not seen as a marketing strategy to generate traffic. So you've got to tick that one off, have your basis in whatever form it is suitable to your business. And then just pick just one source that you can double down on, that you can test, that you can adapt, and do your research before starting in that one channel. And a channel could be LinkedIn, it could be YouTube, it could be writing on somebody else's website, whatever that channel is, or TikTok or Twitter, or email with B2B clients, whatever, or reaching out, not in content, but in sort of leads on LinkedIn, whatever that is. Just focus on one and make sure that you speak to your target audience, and then have consistent effort around it. Nothing is quick when it comes to marketing. And you have to, unfortunately, even with paid marketing, you have to take time, you have to test, you have to adapt. And so what you really need is a lot of patience and a clear understanding of where your audience is. And then you make whatever that strategy is around your audience.
Nice. What do you call it? I have two more questions. Shall I keep going? You seem to be going well.
Okay,
Right,
yeah, that's cool.
We'll finish
Fine.
it. We'll finish it out then. So how much funding do I really need?
So this was a kind of a helpful lesson that I learned, is that you've got to first understand the funding landscape, essentially, You know, you've got pre-seed, or you've got the sort of bootstrapping family and friends, or your initial cash that you start with. Then you've got the pre-seed and the seed, and then as it evolves and you're now into post-revenue or Series A, Series B, and all of this journey, you have the potential to raise money to build and grow your business. Now, that also totally relates to what your product is or your service is. So if your product is a tech or a software, then that journey that I've just said is probably really typical. You might start with some angel investments early on whilst you're developing your MVP. Then you might move into bigger ticket angel investments when you're it's still in seed, but you might then walk into VC investment. But if you're a small business, when the returns for an investor are not going to be large, so you can see clearly that, say, if somebody was to invest in Google, and Google has been enormous, that would be attractive to a VC or an angel. Now, a coffee shop is not necessarily attractive to an angel, because how is the angel going to get their money back out? So they're putting their money in to make a higher return rather than just keeping that money in the bank. So essentially, they're going to want to have much higher returns on that money than they would if they put that in sort of a 5% or an 8% bank. And so if you had a coffee shop and your plan was to have a chain of coffee shops, and you had a really creative strategy about doing that, or like WeWork was changing the way in which, maybe WeWork's not a good example, but changing the different ways of which businesses has gone today with a really clear strategy and a great business plan, that's when you would excite and interest angels. So you only want, so to answer your original question, it depends on what type of business you are and what stage you're at, but you only ever want to raise enough money for your next milestone, your next stage. And the reason being is because you need to guard your equity in the business. You don't want to get to the point where, and there's lots of different things to consider when you're getting investment, but you have to be aware to borrow as little money as possible, but enough so that you can meet your milestone. Because at the next milestone, you're going to have to, most likely, not definitely, but you're most likely going to have to borrow again, or rather take on additional funding for equity. And you have to be mindful of the dilution of your overall equity. Now, if you felt, for example, you were only going to need one round and you gave away 50% of your business, and you borrowed £1 million, but you only spent, and you only actually needed half of that, you've basically given away half of your equity for too much money, when you only could have, if you looked at everything correctly, or taken the time to plan and challenged every expectation or estimate. And if you in reality only needed to spend $500,000, you didn't need $1 million, you could have given away less equity. So it is always about planning that out and forecasting. And then to break the forecasting down, it is your costs. So your essential costs, your marketing, the people that are going to be in your the next 18 months ideally. Then you're effectively the MVP, what you need in order to build that software or that service or to deliver. So it's your suppliers, your costs, and trying to map that out with as much data as possible. And for every line item, whether it's a website, whether it's the products, whether it's supply, whether it's a team member, looking at what type of salary would that person need, how many people do I need, do I really need 3, can I deliver it with just 1, and really trying to hone down and reduce your forecast. And that process in itself is very time consuming, and it's important that you lay that out, ideally with like a 3-year forecast.
I was just thinking it would be good if somebody with some experience could create some sort of course or something like that, going through all of the
Yes.
Okay. Last question. Last question. How do I value my own company for investment purposes?
Okay. So again, that really depends. I'm assuming that the person asking is coming from a very early stage when it's probably in this either ideation or the MVP stage, because once you get a little bit further than that, you've got more traction and then you've got more data and you can then compare it against the industry and what everybody else is getting. So the big question mark is, before you've got all of that, before you can compare yourself and say, oh, I'm like this competitor and they raised XYZ and this is how much therefore I can justify, is a big gray area where it's like unknown, and there's two unknowns. You've got idea and then you've got kind of with the MVP. Obviously, when it's just an idea, it is, if you need money at that stage and you can't bootstrap it, you're really going to it's going to be tough unless you're a second time successful founder. If you're a first time founder, I would really say try your best to bootstrap. Do whatever you can, have a side hustle to start building your product and getting it to an MVP stage, because otherwise you're going to be giving away way too much money than is really comfortable. If you've got, however, interested investors that know you, that they are aware of your background, that they trust you already because they've been working with you or they've known you for years, i.e. it's really good to build those investor relationships now, and they see that, then they can say, I trust that she's going to do what she says she's going to do. And then you can use data, and then you look at the industry, you look at the opportunity, you look at the size, you look at the revenue, you build your forecast. But at the end of the day, with all of that data, which is just supporting, give me money and I believe I can do it, at the end of the day, the investor is going to want a return on their money. And so typically an investor will want to have between 10 and 20% of your business. Now, angel investors that are really early on in the business formation, in that ideation and MVP stage, will demand a higher percentage because they're taking all the risk on. At a later stage, an angel coming in when you've got your customers and you're making some money, they have no right to demand a huge amount of equity, because you've got the proof and there's still a lot of risk, but there's less risk involved. And so really, at the end of the day, that all being said, it's down to what the investor is willing to give you. So that's why, again, it's really important to have as many fingers in as many pots as possible, know as many investors as possible. Don't just rely on a couple, because then you are really dictated to of what that value will be. If you have already 10 relationships and people who are in your industry and they know what your business is going to be worth and they believe in you, then you can negotiate a higher valuation. If you only have a couple, then the angels will probably dictate what that value is. But that being said, I would say for an idea, it's around 650K. For an MVP, it starts to go up to 750, and with more data, with more, maybe some brands, maybe some customers, it might be 950, a million, and it really does depend on the metrics.
Cool. So, well, that's really it for me from the question side. So, thank you very much for that, Helena.
Oh no, you're welcome.
Yeah.
Well, thank you everybody for submitting the questions. That was great. Thank you. Great questions.
Yeah.
Okay. Well, thank you. I think then we'll next week we'll jump on board, and if you guys have got any questions, if you again can't make our time slot, feel free to send any questions through to Aaron or myself, and we'll go through them on the day, and then we'll share the recordings in the classrooms, which you can unlock when you engage. Okay, so have a great week, and I look forward to seeing you next week.
Perfect. See you guys.
Bye.
Bye-bye.